When we first start our business, we're going to want to acquire some assets, say some buildings. We're going to have to invest in inventory. We might want to buy some equipment. We're going to incur costs. We're going to need to pay employees, spend money on advertising. But all of these things require cash. So the question then becomes, where do we get that cash? We have one of two places we can get that cash. We can invest the money ourselves, which would be stockholders' equity, or we could borrow money from the bank. Let's go ahead and take a look at some basic transactions and how they would impact our accounting equation. First, let's begin with our stockholders. That's the owners of a company. Invest $10,000 in the business in exchange for common stock. That would be considered a transaction because it changes the assets, liability, or equity of the business. And we are getting $10,000 in cash, so we've got a $10,000 increase in cash, and that's going to be offset by an owner's claim of $10,000 in common stock. And notice our accounting equation of balances, and this would be considered financing cash flow. Anything involving contributions by investors, either debt or equity, would be considered a financing cash flow. In B, we've got the company borrows $15,000 by signing a note payable with a bank that's due in 3 months. Again, that's a transaction. It's impacting our accounting equation. We're getting $15,000 in cash, and we're going to then increase also our liabilities on notes payable. And again, this would be an example of a financing cash flow. Item C, we receive and pay $15,000 for a truck, $5,000 for equipment. So once again, we've got a transaction, yes. And in this case, we are paying $15,000 for a truck and $5,000 for equipment. So we've got assets going up. We're going to put those both as equipment. And of course, we paid for that using cash, so we have cash going down by $20,000. And notice our accounting equation once again balances. This would be an example of an investing cash flow. We're purchasing long-term assets for the use in our business. Item D, purchase $300 of supplies on account. So we're getting an asset and we have a liability. And again, this is an example of a transaction. We're getting $300 in supplies. We're not paying for it right now. If we were paying for it right now, we would have a $300 decrease in cash. But we're not paying for it now. We're going to pay for it later. That's what we mean by purchasing on account. So we have a $300 increase in accounts payable. And again, our accounting equation balances. This is an example of an operating activity, but it did not involve cash, so there's no impact on our cash flow statement. E, we sign a contract for first website design for $10,000. This is not a transaction. We have no change currently in our assets or liabilities. We've signed a contract for web design, and when the web design company provides that service and actually designs our website, then we will have basically it'll be an expense at that point in time, and we'll have a liability. So at that point in time, there will be a transaction. F, we paid $300 to the supplier in Part D. Remember up here we purchased supplies and recorded in accounts payable. Now we're going to pay that. So the liability will go down by $300, as will of course our cash. It's going down by $300. And again, this is an example of a transaction. This involved a cash outflow, and it is an operating cash flow. It has to do with things that take place as part of our day-to-day operations. G, we purchased and pay for $600 of supplies. Yes, this is a transaction. We received $600 of supplies, and we paid cash right now. So again, notice this time we have an operating cash flow when we receive the supplies because we've actually paid for the paid cash at this point in time. We purchase and pay for equipment costing $3,000. Again, yes, it is a transaction. It's impacting our accounting equation. We have a $1,000 increase in equipment, and we have a $1,000 decrease in cash. And again, we don't typically buy equipment as part of our operating activities. This would be considered an investing activity, a long-term asset that we're going to use in our business over time. We order a $900 lawnmower to be delivered next month. This is not a transaction. At the point in time when the lawnmower is delivered, we will of course have an increase in equipment, and if they send us an invoice, we would have an accounts payable. But until we receive that equipment, there is no transaction.